This is the shot in the arm that the market needs, again, similar to the relief package which was signed a few weeks ago.
Yeah, so the 2 trillion package, on the back of the 1.9 trillion of relief, really reinforced the V-shaped recovery in the US for this year. And of course, the beneficiaries of that are the infrastructure plays, be it 5G, be it semiconductor, manufacturing, onshoring kind of plays. And of course, financials. With the yield curve steepening, we think banks would be a primary beneficiary of these 2 packages.
Well, how will the bond market react to this? We've already had fears about inflation from the relief package. Are we going to get more fears here with all this spending being made on the ground?
Yeah, so the markets have reacted. So the 10-year Treasury was 0.9, now it's closer to 1.7. It's a massive move, but we think that it would be capped at about 2% at most, because really the structural headwinds for inflation are still there, right? Demographics, as well as the digitalization of the world economy. Really, the forerunner of this is Japan. If you look at Japan, I mean, they have been doing QE, deficit spending for the last 2 decades, and inflation never appeared because why? Demographics.
Wey Fook, we are starting out the new quarter here too with this stimulus optimism, but we're also looking in terms of where we're going to see rotation continue into the next part of the year. Our question of the day that we're asking all our guests is, where do you see some opportunities in this new quarter?
Yeah, we think the rotation that we had seen in the first quarter, from technology towards the laggard sectors of energy as well as financials. That is really a broadening of the market. Interesting to note that technology as a sector did not fall year to date, which tells me that it's a net infusion of cash from other asset classes into the equity markets. Now, where are the winners? We continue to like the secular plays of, the theme, the world becoming a digital economy. But the tactical plays are really the pandemic victims becoming vaccine winners. So, for example, we would like financials. I think banks have been underperforming. It would do well. In the Asian space, we like, property related. We like tourism, hotels in particular, integrated resorts, as well as for income generation, Singapore REITs.
What you don't like, though, it seems, is Japanese equities. We just had the pretty positive read on the Tankan survey. Japan's economy looking pretty positive from that read. Why are you staying away from Japan?
Yeah, so really our approach to managing our portfolios is to kind of barbell it. So on one end, buy into secular plays, on the other, income-generating assets. So looking at it from that perspective, really the secular plays as well as the income plays, we can't find too much of that in Japan nor Europe. So in our asset allocation, we are overweight US and Asia to play up that barbell strategy that we have been advocating for the last 2 to 3 years.
All right, I also wanted to talk to you about where you're seeing opportunities in debt, because I understand you're looking particularly here at some of the Chinese onshore bonds.
Yeah, I think the Chinese onshore bonds in renminbi will be a beneficiary of what we call the markets opening up and more foreign flows into the onshore market. At the same time, because the currency is expected to be pretty resilient against the US dollar, and you have a pickup of about 180 basis points over US Treasuries, we therefore think that there is an opportunity there for you to capture incremental returns with a rather stable currency.
Wey Fook, I was reading your research and I was rather intrigued by what you were writing about us being at an inflection point of moving from a new hope to, quote, back on track. What did you mean by that?
Yeah, so in our quarterly publications at the start of the year, we said there a new hope because of the rollout of vaccines. Now that we are seeing that happening before our eyes, the subsequent quarter or this quarter, really the world is normalizing and we are back on track, So we do see economies reopening. But we think, one has to be engaged in equities, be constructive about it. However, the returns will be a lot less. As you would know, in all bull markets, the initial phase is the strongest. When the investor sentiment is that of pessimism and skepticism, that's where you have the greatest returns. Now we are moving from skepticism to optimism. We think we still like the markets, except that maybe the returns are not going to be as fantastic as what we have seen. From the lows of March last year till the end of the year, up 70%. So likely to be high single digits, low double digits